returns have been this strong for this long because the manager's natural question will be, what should I be selling because everything has increased so much? When we look over on the other side, the other table at the top, the bond total market returns, remember this is an important part of the portfolio. You can see that long treasuries were up 5.5%. Remember, when equities go down, treasury bonds traditionally go up despite how low interest rates are now, and you see that over the last year that relationship was true, where you had equities up in tremendous rally, you had treasury bonds, long treasury bonds actually lost market value during the year. And as you look for the two charts that we show, how performance shook out during the year-to-date performance for equities, and you can see by sector what really was hurt badly. Consumer discretionary down 7%. Materials down 4.5%, industrials, energy, you can see all of those down 4+%. The only industry or sector breakdown that was positive for the month was healthcare and utilities, two of the very most defensive sectors that you can see. Out of all of the explanations we've heard of for the sell-off during the month of January, the most plausible that we have heard has been that it was tax-related selling because investors enjoyed incredible gains during the year. However, tax law changes on individuals meant that if you sold gains off during the year 2013, they're subjected to much higher capital gains rates than they had before, and if you just waited to sell a few days later in January, then you're not due paying the tax for until the end of this year. So we think that that was tax-related selling for the most part. We think that gains were justifiably taken, but the market is not in bubble territory like internet era bubble, etc. The following page shows you the returns of the individual investments and the total fund. You will see that the portfolio continues to be cautiously allocated to active investment managers who have very unique investment processes and styles. And you will see as we go for the last 1 year period, 9.4% rate of return. The managers that we have selected sometimes do lag when the market goes up extraordinarily quickly because they're very rational investors. Hopefully you would see that they would hold up better than expected on the downside, but unfortunately our managers, for a variety of reasons, you'll see Dreyfus Appreciation does not hold utilities, and they do not hold a whole lot in healthcare, and they're down for the month. You'll see that Delafield invests in fairly risky companies, but in a unique structure, was down quite a bit more than its benchmark, and you'll see that Stevens was right at its benchmark for the period. Thornburg is the manager we're going to talk about a little bit more in a few moments after we go through the monthly report. But as far as this 1 month period of time, it was difficult. It was very difficult on rational investors. It was very difficult on blue chip stocks for Dreyfus Appreciation, and it was difficult for our international equity manager because they hold a little bit more in emerging markets than some of the others. But if we go back over the last 1 year, we put together these returns, a 9.4% rate of return, and over the last 3 years, annualized 7.1%. Do we wish it was higher? Yes, we do, but we also recognize that we have been allocating to this portfolio over time, and we are doing it in a very disciplined and a very rational and a very risk-conscious method because we understand what these assets stand for, and we do not want to do anything imprudent with them. So giving up some of the upside for additional downside protection over long periods of time, we think still continues to be a rational investment policy. Happy to take any questions about the report. The one thing that I forgot to mention is the total market value is we're up above $25 million, and that growth has come fairly dramatically over the last year through contributions, but also through returns from the equity portfolios. Happy to take any questions about the monthly report.
Are there any questions? All right. The next item that we have then is so we could receive the flash report for January 31st. If I could get a motion.
Second.
All in favor?
Aye.
Any opposed? All right. Next item is the quarterly report for the fourth quarter of 2013.
Sure, we're going to go into the time machine and go back a month from what we've just seen. We just saw January 31, 2014. We're going to look at the December 31st, 2013. Same portfolio, no changes during the month. You'll see returns of the market performance update on page of the second page as you open it up, and you'll see how dramatically different the returns are. The month of December was positive for equities, except for emerging markets. The last 1 year, this would be the calendar year, 2013, is the last year column, and you see rates of return anywhere from almost 30% for the Dow Jones average all the way to 43% for small cap growth equities. International equities did okay. They didn't do quite as well as domestic stocks did, but still a diversified portfolio of international shares would have been up almost 21% for the year, which is remarkably good, given the uncertainty that Europe, that Japan, that other areas have seen. The emerging markets were a real outlier last year. Started around midway through the year. You can see that for that period, they were, for the year, while international stocks were up 21, they were down 2%, which is a very wide dispersion of returns, but not unprecedented for emerging markets. If we look at the bond market total returns, it's interesting there. You see that T-bills continue to pay nothing, but the Treasury bond was down 12.7% before coming back almost 6% during the month of January. So Treasury bond prices are extremely volatile, and they're very good hedges versus equity market volatility. The aggregate index, which is an unusual situation to see, the BC US aggregate, sort of like the S&P 500 of the bond world. It is all investment grade or better. It includes governments, treasuries, corporates, and mortgage-backed securities. It does not include any municipal debt, and it was down 2% for the year. So you can see where most of the market was, investors were focused on equities to the expense of fixed income, and equity investors were very, very well rewarded during the year. You'll see on the following page, page 3, and then the page numbers are on the left-hand side near the top in the green box. You'll see over the last year, domestic equities for the portfolio were up 27.5%. International equities up 15.6%, and the composite was up 16.7% for the 1 year ended December 31. And if we go back over the last 3 years, you can see the results there. The last quarter is the far left-hand group of columns there. Equities were up 5%, international were up 4.3%, the fixed income was down 0.1%, and the composite was up 5.3%, which during the fourth quarter of last year, the trust's assets outperformed the actuarial assumption for the entire year during that one last quarter of 2013. As we go on following pages, you can see annual return history. The results here on page 4 and page 5 are a history lesson of what's been going on. You can see that 2011 was the last time that we had to endure a loss of the portfolio. It was down 1.84%, but it's been very, very good results since then. The dark green column is the total fund, up 11.81 during 2012 and 16.74 for the year 2013. And when we have years this good on absolute terms, what we want to do is make sure that we're not getting overexcited, that expectations are that equities are going to go up 20 and 30% every year, because we don't believe that. Nor do we believe that fixed income will continue to go down every year. And we want to make sure that we have a balance between income-producing assets and capital appreciation. As we go to page 6, you can see that discussion items, great returns during the fourth quarter. 2012, the investment committee made a transition to a new portfolio structure where we diversified out the domestic equity portfolios from 1 to 3 managers. The transition to this happened in April of 2012. And as we go back from the 2009-2010 period, remember how difficult and how frightening that period of time was. The total fund had almost an exception from its investment policy targets to carry more fixed income than required by investment policy, and at that time that was very prudent to do that. As we see on page 7 is a great page. You see that the asset value has increased tremendously, up to $26.5 million, up from the beginning value, which was $6 million in 2009. So you go from $6 million to $26 million over a 4-year period of time. That's pretty phenomenal growth, but again, it's been done in a measured and very disciplined manner. As cash flows have come in during the year 2013, they were applied to areas that were underweight versus investment policy. So during the year last year, we actually gave assets to fixed income. We actually gave assets to large cap equity, and we gave assets to international equity because our small cap and our mid cap portfolios were performing so well so fast. The next few pages we'll go through the portfolio. On page 8, JP Morgan Core Bond Fund. The portfolio has one bond portfolio. It's diversified. It's 28% of the total fund. It's done okay over recent years. Its performance is cautious. It's not supposed to be an aggressive bond portfolio because we're taking that type of risk on the equity side. JP Morgan tends to invest more in mortgage backs rather than corporate bonds, which is part of the portfolio or part of the bond market that performed the best last year. You can see over the last 3 years, which is a period of time that the trust has invested in this portfolio, the entire time the total return was 3.46 versus 3.26 for its benchmark index, and these are net of fees results, so it did outperform. Over the last 12 months, it outperformed, and over the last quarter, it outperformed. It's done this by having shorter duration and that's the primary reason. If we look at the sector allocation on the right-hand side of the page, you see that asset-backed securities, collateralized mortgage obligations, and commercial mortgage-backed securities make up a lot of the portfolio, more than others, and that's always been the case with this portfolio management team. JP Morgan is the fund manager, distributor. The team that manages this is actually in Ohio and came to JP Morgan through a series of mergers and acquisitions. This used to be Bank One, if you remember that organization some time ago. Page 9 is Dreyfus Appreciation, a unique portfolio in our estimation, one that gives upside participation but also downside protection. It is a very long-term oriented investment. It is as liquid as anything out there. They invest in very, very large companies. Very, very large companies were not the best place to be invested, but if you look at the names of the holdings in this portfolio, you would recognize every single one of them, all 67 of them. You see that they have large investments on a sector weighting basis in consumer defensives. They have invested with consumers throughout their history. You'll see that energy is at 18.1% versus 4.6% for the benchmark. And they're investing in what tend to be more of the mega energy companies. ExxonMobil has been one of the largest holdings in their portfolio for over a decade. You can see that Apple Computer is also another large holding of theirs, which has been under a significant pressure because of corporate raider. Carl Icahn has been applying pressure there. And it's somewhat lost, I think, that Apple Computer continues to be an incredible franchise, a great company, and they have so much cash on their balance sheet. I think they could buy the next two largest technology companies with cash that they have on their balance sheet right now. So we think that the holdings in this portfolio continue to be very strong. They're not paying over much for the portfolio. One thing I like about this is that the yield on the holdings is on average almost 3% per year. And so during a year that the market goes up 33.5%, driven by mid-caps and small-cap companies, it's not unusual to see this, but we think this is a very prudent long-term investment, and we do not think that we should be taking any action on this portfolio. Patience is going to be a virtue with this portfolio. And remember, this is getting us inexpensive exposure to very large, stable growing companies out there, which sometimes they don't tend to perform as well as the market. Also, something that did impact performance here is the allocation to non-U.S. equities, which is something that they have always believed in. 83.7% of the holdings were U.S.-based and traded companies. 16.3% were based outside of the United States, and if you remember, the difference between U.S. and non-U.S. performance was fairly different with U.S. equities outperforming. Another thing that about this, the companies held in this portfolio, about 2/3 of the overall revenues of all the underlying companies come from non-U.S. sources. So as there's growth in the emerging markets, as there's growth in Europe, as there's growth in Japan, not only growth in the United States, you have good revenue exposure within this portfolio.
So the performance compared to the benchmark then, at the top of the page there with the Russell 1000,
Yes.
so it's consistently performing. So what you're explaining is why it varies from the benchmark?
Yes. We think that this is a very good, cautious, large cap growth exposure. And if you look on the right-hand side, key characteristics, if you look here, I'm going to go down almost just a little bit more than halfway and see the weighted average market cap in millions there. I apologize for all of the abbreviations. The weighted average market cap for this fund is roughly $115 billion. So these are extremely large, stable companies, whereas the index is less than half of that. That was done by choice. We wanted exposure to growth companies. We wanted exposure, but we wanted very, very stable, strong companies with very strong balance sheets and the ability to sustain a difficult period in the market. If you look at this, the PE ratio here is 15.9. If you look on the Russell 1000 growth, it's 21.9. So it's considerably more expensive. But if you look at the growth rates on the companies, and I was looking at these last night, the growth rates, especially on growth of book value, is so incredibly high versus the market. Even earnings growth looking forward next year is superior to the index. So in our eyes, what you're getting, you're buying very large, very dominant, globally oriented franchises, and you're paying significantly less than you would for lower quality companies in the market. And that's just how the market is pricing these risks right now. So we think that if you look at past performance over the last year, we're not happy with a 21.5% rate of return versus 33.5% for that index, but we understand that they're investing in pretty different names. These are the biggest of the big companies, and that's something that did not help performance last year. Smaller, more aggressive, more difficult, it's just saying that large companies were not the best place to be, and that's common when you have blow-off markets like this, that you're up 40% in some parts of the market. That tends to gravitate capital from these companies there. But if the market hits a rough patch, traditionally that would tend to happen. January, if you think back, this fund did not perform well, but we think that also that's some tax-related selling, and it's not really attributable to market fundamentals. Yes?
Did I understand you correctly to say that 2/3 of the revenue from all the brightest companies come from non-U.S. sources?
Yes. I might be a little bit high on that, but significant amounts of the revenue of these companies come from global operations. There's also been some talk, one of the reasons that Apple has come back off of some of its recent highs and some of the other companies that are global oriented is that these companies have these enormous cash reserves that are effectively stranded overseas. Because they make the sales overseas through their foreign subsidiaries, and they cannot repatriate the cash back without paying what they think to be overmuch taxes on that. So that has hurt some companies with significant overseas operations. But if you look at this, Apple Computer, the dominant brand name when it comes to technology in the world, and if you can buy it now for the prices that you're paying, I think that that's going to be a good investment over time. ExxonMobil, I know that a lot of the energy attention that we have around here is on domestic-based energy production, and that rightfully so, but Exxon will have a piece of that over time. And if you look at Philip Morris, well, it may not be we may not be incredibly comfortable with the products that they're selling. Philip Morris is increasing their sales and their brand loyalty throughout China, India, et cetera. So these are companies that have very long-lived growth cycles and are not flavor of the day. We think that they're durable, that they're resilient, and if I'm looking at a return that's 21.5% and I'm buying the strongest global franchises in the world and I'm still getting it at less than 16 times earnings, I'm comfortable with that going forward. There have been no changes with the management team that manages this portfolio, and I think it's also important to note that the underlying portfolio manager, it's a company called Faya Seraphim, a well-known firm in Houston, Texas. Not only do they invest in their own portfolio, their retirement plan is solely invested in this portfolio. So they are not managing this with a short-term focus. They're managing this with a very long-term, very stable orientation. The next page is Delafield. Delafield is our mid-cap value equity. Remember, our domestic equity portfolio has three pieces. Each of them are important. Our large-cap growth, which we just talked about, then we have mid-cap value, and then we have a small-cap growth. So from a style and size, the checkerboard or the tic-tac-toe board, we have large core to growth on one at the very top, then we have mid-value, and then we have small growth. And it's engineered that way so that they work together. If you look at this portfolio over the last year, again, you might notice that sometimes over short periods of time, the managers have difficult comparisons to some of their peers because they're really not like their peers. We go after unique portfolios, and Delafield is one of these. The last quarter, they were up 8.2%. The last year, they were up 29.06%. And that's a difficult universe comparison. Over the last 3 years, they're up almost 13%. And over the last 5 years, that's the good and the bad period, they're up 22.3%. These are smaller companies. They're mid-sized. Remember the last portfolio, the average market cap was $115 billion. This is $4 billion. Delafield, this fund is managed by two people, Dennis Delafield and Vince Selecchia. They've been together managing this portfolio for almost 30 years in this style. So short-term is not really their investment process. If you look at the sector weightings in this portfolio, it's quite different than the index. You'll notice that basic materials, and these are companies that you want to buy when their prices are a little bit higher than normal. Basic materials is 25% of the portfolio. Basic materials is not a part of the market that performed well last year. Communication services, almost nothing. You'll see the consumer cyclicals, 16.2, doubled the benchmark. And as you go down, they have a nice allocation to technology and utilities and real estate, which are two more and more significant areas of the mid-cap market. Real estate through REITs, which are not something that this group invests in because they don't think that that you give up growth over time by investing in REITs, so they stay out of those. But utilities is also something that they don't think ever gets interesting enough for them. So the portfolio, it's up 29% over the last year, even with the 16.6% cash allocation, which is something that they've traditionally had because when they find new opportunities. Their investment process is totally different than Dreyfus. Dreyfus buys big, stable companies. This one buys smaller companies that are undergoing some problems, and they buy them cheaply, and then they get to know management, and they move the companies forward. But again, over the last year, 29%, this is 12% of the portfolio. As we go into Stevens, Stevens was our top performer over the last year, 42.9% rate of return on page 11. This is a distinct portfolio. It is significantly different than either of the two styles that I mentioned before. The weighted average market cap is 1.8 billion. So as we move on, we get smaller and smaller, and the PE ratio of 32 versus 25 for its benchmark. The previous were around 16, so the PE ratio on this fund is significantly higher. And you can see that last year was a good year for small cap growth investors. The last quarter of the year, this portfolio did not maintain its stride with the benchmark, but if you look over the last 1 year, 3 years, and 5 years, it has. At the end of last year, the management team of this portfolio started to take some risk off the table. I think that's natural when you're up almost 40% over the year to play some defense towards the end of it. I had a meeting with the portfolio manager, a fellow named Ryan Crane, of this fund 2 weeks ago in Houston, talking to him about the portfolio. what it's been doing and what they're expecting to see going forward. One of the big areas of opportunity he continues to see is healthcare with the disruptions that have gone on there. Another interesting thing that he mentioned was that internet security is something that they're investing in rather heavily in the wake of the Target data breach and the other data breaches that we've seen. The team is solid. They have reduced the amount of cash flows coming into the fund because they know if they get too large, it's really difficult to provide performance. So we like what we heard from them there. On the final page, page 12, is Thornburg. Thornburg came about when this portfolio was initially funded. It has had very good performance, but recently performance has been quite bad. They tend to also invest in very large companies. They also tend to invest more in emerging markets than the first benchmark, the EFA, which is developed markets only. The ACWI ex-US, just below that, is developed and emerging markets, and you can see the performance has been more in line with the ACWI ex-US benchmark because of that foreign stock exposure. But we're having some questions about Thornburg. Thornburg, remember I mentioned a moment ago, Stevens knows that performance can be hurt if you take in too large of assets into your portfolio. Thornburg, I think, has changed somewhat of their portfolio style to accommodate incredible interest from investors, more and more funds going into this, more people investing, more institutions investing in it. And not only have they taken in what we think to be maybe too much in their portfolio, but they have also recently made a change in the management team of this group. Previously, it was 3 people. It was Bill Freese, Lee Wang, and Wendy Trevisani, where the lead manager was Bill Freese. The other 2 were co-PMs. But they've recently, in the last month, announced that Wendy Trevisani is stepping off of that group into another position within the company. And we're alarmed by that because she's been managing this portfolio for some time. And if she's effectively moving over to manage the same portfolio, but just for different clients, and that sends up some red flags for us. We'd not been happy with performance. We'd not been happy with the amount of asset growth that we had seen in this portfolio, but almost if you put 3 strikes and you're out, the change in the management team is really what's concerning us right now.
So, Doug, a question about that. Have we put them on notice?
Yes.
Yeah. And so, I mean, in my mind, a change in the manager might be a good thing. I mean, do we know who they're going to assign this to now and what their performance has been with other portfolios?
Sure. That's a great question. And I appreciate your optimism very much. Because more often, I have to say, in my experience, more often when you see a company reacting this way, and this is a very specific way they're reacting, they've seen their assets go out, performance has been down. I've met with them in their offices. We've had our founder met with them in their offices. We've known this group of people individually for quite some time. And when we're out there, we're not just meeting with the 3 named PMs. We're also meeting with analysts. We're meeting with trading staff. And there's something that sometimes is lost when a company sort of is an emerging company, when they're growing and they're gaining market share, and then at some point they get so big they're more concerned with keeping assets rather than they are producing investment results. Those are 2 different things. Companies become investment managers, and then they hit a peak point, and they become asset gatherers and holders. And that's the thing that we think is going on here. So when you have a 3-person team, Bill Freese, Lee Wang, and Wendy Trevisani named to this group, Bill Freese is in his mid-70s. Wendy and Lee are much younger, 50s, early 50s. We saw that.
Thank you for calling that younger.
But we saw it. We saw Wendy and Lee being put in as a transition to maybe Bill retiring someday. And now you have Wendy stepping aside to off of this portfolio to manage for just institutional clients. To me, that seems like a reaction to satisfy institutional clients rather than a move that is truly there to enhance investment results. And when you take 3 and you take one person off of there and you're left with 2, one of those fellas is, in his mid to late 70s.
So Frank is worried about you classifying that as old. Okay, so, but
Apologies.
you're pretty sure that they're not bringing someone else onto that team?
That's correct.
Okay. That answers my question.
And culturally, what we're seeing, and we try not to move quickly on these because we're very patient investors, culturally what we're seeing is sort of a more protect what we have, rather than manage the portfolio for its own benefit, unfortunately. It's taken us a while to come to that determination, but we think that effectively their ability to produce the results they have in the past is not the same. But later on in the agenda, you'll find something in your packet where we are offering alternatives to this fund. And I think that we're going to cover that through another item on the agenda. Is that correct?
I think we can just follow that with what we've got here. Like, you can just continue with that on the presentation, right? We won't accept it as a report. He can just provide this additional information.
Yes, we were going to have him do it under reports.
Okay. You're correct then.
Okay. So that is our conclusion on Thornburg. If you go to the following page, you can see the results there, very similar to what we've shown, except for you'll notice the one-year results are quite a bit higher on December 31. The next few pages, I think, are interesting from a historical perspective. You'll see that on 14, the market value, how rapid the increase has been, and you'll see that since 2012, the increases that we've seen. We had the one very large increase in 2010 of $4 million, but you'll see $1.5 million, $3.5 million in 2012 with a fourth quarter of $1 million in addition to that, and you'll see the 2 allocations of $1.75 million in last year. And last year was interesting because it seemed like we would give assets to a portfolio, the more cautious portfolios, to balance it back to target, and then the next time it came to allocate funds, we'd have to allocate it to the same ones because the same smaller mid-cap portfolios were running so fast. If we go on, I don't want to take too much longer here, but on page 17, the domestic equity portfolio statistics, and this is when we combine the 3 domestic equity portfolios. You see their characteristics there. We think that those are attractive. The alpha is positive, the beta is less than the market, and the R-squared is somewhat less than the market. But we're happy, especially when we look at the risk return over the last 5 years, what this portfolio would have done. It would have provided higher than market returns, but the next column, the next row there, standard deviation of 15.89 versus 15.81 means you're not taking excessive risk to enjoy that higher than market return. And I think that it's also important, if we go to page 20, the manager status summary. No changes to this at the time, but we are offering alternatives to Thornburg in a few moments.
All right, are there any questions? Okay, do we need to actually accept that report, the presentation? We don't have to take any action on this one. Okay. All right, thank you.
Thank you.
Next item is to adopt the joint resolution authorizing an agreement with United Healthcare of Oklahoma. And we'll have Colin come and just speak real quickly to what's included in that contract for our HMO services for the retirees.
What this item is the tri-party agreement between Opebt, OCMFA, the Municipal Facilities Authority, and the City of Oklahoma City. The city decided to contract with United Healthcare for its health maintenance organization and Medicare Advantage services for the benefit plans. This contract authorizes expenditures of monies for the Opebt side of the house, which would be for HMO services for retirees under 65, and for those that are 65 over, it's the Medicare Advantage plan. So this ties together a multi-year, 5-year agreement with United Healthcare, and brings into the funding source for the OPEB along with the MFA, which is the paying source for the active employees. Questions?
Any questions for Colin?
Yeah, I'm way behind the curve on this one. Does this affect anyone who's on the indemnity plan?
No. This is only for HMO or Medicare Advantage members.
So if you're on the indemnity plan,
That contract is,
Social Security, that contract also is not affected.
we don't have a contract with Social Security. The indemnity plan is administered by Blue Cross Blue Shield of Oklahoma, and so that is our two preferred provider organization style plans. Medicare is an independent deal, and our indemnity plan is a coordination of benefits plan with Medicare and our plan and how the claims are adjudicated, meaning Medicare comes first. This plan, through United Healthcare, is a Medicare Advantage plan, and if you're on Medicare, the Medicare Advantage plan takes the place of Medicare. So there's no coordination. It is a replacement plan that's subsidized by the Medicare folks. Does that answer where we're going? Okay.
All right.
Move approval.
Okay, all in favor?
Aye.
Any opposed? Next item is the acceptance of the interim financial reports for the 6 months ended December 31st, 2013. We'll ask Matt Bogg, he's one of our accounting managers, to just give us a brief overview on the financials.
Good morning. Just like Craig said, I want to just touch over a few key areas. If you would please turn to page 6 of the reports that you've been given. That's our statement of changes in plan net position for the 6 months ended December 31st. We've seen the trend that we've seen of the increasing net position has continued. We were looking at a $30.33 million net position at the end of this time period. For comparison's sake, that was 22.29 at December 31st, 2012. That's an $8.03 million increase. For further perspective, at the beginning of this fiscal year, July 1st, we had a $26.3 million net position, so it's an increase of $4.02 million during this 6-month period. How that breaks out, $2.6 million, the vast majority is going to be from our net investment income over this 6 months. The remaining is going to be the total contributions over our benefits paid of about $1.4 million, makes up the rest of that. If we just look at it by line item, our total additions are up $1.62 million compared to 2012. That's going to be primarily due to the increase in net investment income. Going down, our total deductions were up about $702,000. The vast majority of that's going to be $720,000 from the deductions, how they increased. I'd also like to just point out on page 10 of the report, we have our asset allocation guidelines. Our target amounts for equities is 60%. We're right around there at 61.9. Also notice our fixed income target of 30. We're just a little under at 28.1, and internationals are spot on at 10%. Also in the footnote there, just to point out our balance in money market accounts, $2.4 million this year compared to $4.2 at December 31st, 2012. Are there any other questions?
Any questions? Thank you, Matt.
Thank you.
Take a motion to receive or to accept the interim financial statements. All in favor? Any opposed? All right, next item is to ratify the claims listing. Take a motion. Okay.
What is the expenditure to preschool first class? Postage.
That'd be postage, just mailing out of the retiree enrollment handbooks, all of them, the sorting and mailing out to everybody.
I understand postage, I see you know what we're ready. Is there a motion?
So moved.
Second.
All in favor? Any opposed? All right, and with that, we'll have reports or comments from trustees, staff, or interested parties, and Bob has something he was going to present or discuss.
Actually, I wasn't sure exactly where the proper place for this was, but I did have a question in regard to the fourth quarter investment report for Doug. We also have one other item that we did want to present to you as part of this, the investment portfolio, which we'll get to in just a second. My question for Doug was in relation to the Delafield Fund. Within on page 10 of your fourth quarter report, I was just briefly discussing with Doug that I noticed that within the sector weightings, we have some pretty significant differences between what the benchmark is carrying and what the fund itself actually is. And my question to Doug was whether or not this was maybe a sign of some style drift, or whether or not, this is just how this particular fund functions, and if that's what that we're expecting to see with Delafield. So I'll let Doug kind of touch on that.
Thanks for the question. If you go to page 10 on your report, you'll notice that on the sector weightings, and this is a great question because it gets to the heart of why we hire managers to do this. The benchmark, for instance, on the Russell Mid-Cap Value, on the very top row, basic materials, is 4.7%. Delafield does invest in much more heavily in that sector, and they have historically invested in that sector because it's an area that they can find good companies at good value with management teams that can execute. If you'll go down to, I mentioned this when we were talking before, healthcare is a low allocation. Utilities is a very low allocation, even though it's a large proportion of the index at 11.2%. But Delafield, they do not invest in utilities. They historically never have because the companies are very well regulated. They tend not to have periods where they're severely undervalued, and that's when Delafield gets interested. Something that you'll notice here is that financial services makes up almost 20% of the index. Only 3% of the portfolio, of Delafield's portfolio, is there because it's not an area that they have expertise like in basic materials. Again, they think that banks are difficult to analyze. They think that, unfortunately, sometimes banks are subjected to risks that they can't forecast, they can't prepare for, and so they stay out of those areas. So that's a great question, and it's something that we look at for all the portfolios. One of the reasons that we think that Thornburg is having some issues right now is because they're trying to invest in areas that maybe haven't had the expertise in the past, and that troubles us. So somebody like Delafield, this is exactly what we expect from them, and the results are watched closely, and it's a good question, very good question. Thanks.
Appreciate it, Doug. You have one other item in your packet. This is the International Equity Review. We didn't have this on the agenda, however. My understanding is that Doug can still go ahead and cover the information. We just can't take any action on it today. So we're going to have him cover this for you in this section of the agenda.
Thanks again, Bob. Thanks, everyone, for your patience today. I know I'm going on quite a bit. I know we have significant agenda items here. This refers to the potential replacement for Thornburg. These are some candidates that we know well and we've compiled for consideration. I think it's important to note that the current allocation of Thornburg is on target at 10% of the portfolio, and we're talking about roughly $2.5 million at current market values. We have the background. We're all familiar with that item. On page 3, you see our search process, which is in-depth. It is updated continuously, and we start with a review of all international equity funds that are of adequate size and experience. We look at the performance of the firms historically. We look at personnel stability historically, and we look at style drift also as well to make sure that they are adhering to an investment process. That gets us down to a qualitative review, and it gets us down to a short list of candidates. We have assets with all of these managers, and we've had assets with all of these managers for at least as long as we have with Thornburg, with our other clients. Tocqueville, interestingly enough, is the owner of Delafield, and they have a similarly unique investment style where they're contrarian and very focused portfolios. The others are different in their own way. And then step 4, I'm not sure when this happens, but I'm introducing these firms to you today, and I'm here to answer any questions. If we look at the next page, the important page is performance. These portfolios are ranked by the rating services in slightly different categories, but if you go back, say, over the last 5 years, you can compare performance. The percentile ranks are in different universes in some cases, but we show the 4 candidates, we show the existing manager, we show 2 benchmarks, and you can see performance has been good for all of these names, in fact, better than it has been for Thornburg. And one thing that you will find that all of these are similar is that they have lower emerging markets exposure, which if you go back 3 years ago was the hottest asset class for investors, but since that time has not been so great. These managers invest some in emerging markets, just not as high as a Thornburg. And the one emerging market that Thornburg knows the best is China, and we don't expect great results from there going forward. But over the last 5 years, Causeway was up 15.5%, Harbor was up 14.25%, Oakmark was up 21.1%, Tocqueville up 14.3%, all of these superior to Thornburg, and all of these are net of investment management fees. These results, if you look back over the last 3 months and over the last year, if you sort of extrapolate the return over the last 1 year and its impact on the 5-year result, unfortunately, most of the pain or the underperformance of that 5-year period came within the last year of Thornburg. These are annualized rates of return for all of these managers and net of fees. On a risk-return scatter plot on page 5, these charts tell you that over the last 3 years and over the last 5 years, the current investor, the other opportunities, and on the horizontal axis, or as we move from left to right, the further right you are, the more volatile you are, and the vertical axis tells you the return that you enjoyed over that period of time. So over the last 3 years, Oakmark was up a little bit under 14%, and they had the highest volatility of any of the managers. Causeway, slightly less than that. You see Tocqueville all over by themselves, and Thornburg slightly higher than the Aqua US with less volatility. Over the last 5 years, you can see very low volatility on Thornburg, very high volatility on Oakmark and Causeway, but those are really, interestingly enough, less emerging markets exposure, and some of that standard deviation is definitely a part of the higher return. As your returns are higher, your standard deviation naturally goes higher as well. Next page shows the portfolio characteristics. These are all prudent in our mind. If we look at something like number of holdings, tells you how diversified they are. It's wide-ranging. Causeway at 67 is a fairly compact portfolio, especially when you consider they're investing throughout the world. Harbor with 99, the highest, 99 holdings, the highest of the group. You'll see as we move down the list of 63 and 86, and the average market capitalization does vary somewhat as well. Harbor, the highest of the candidates, explaining some of their performance over the last year. Tocqueville, the very lowest at $9 billion average weighted market cap. So they do have some small caps within their portfolio. The PE ratios, the price to book can tell you how much the managers are paying, and price to sales. It's very interesting. Causeway is paying 1 times annual sales when they're buying companies on the open market. You go down to somebody like Tocqueville, who is buying distressed companies or companies that are steeply discounted, and they're buying them for less than 1 year's sales on average. The alphas and the betas, the R-squared, the Sharpe ratios, et cetera, are on the next page, page 7. Betas are all fairly close to the market, exception of Tocqueville, very low at 0.88. The R-squareds versus the index are reasonable, about what we would expect. Oakmark is the most diverse from the benchmark, but Sharpe ratio, which is a risk-adjusted rate of return, meaning How much risk did you have to take to get the returns that you enjoyed? Causeway, very high. Oakmark, extremely high. And they have been over this period of time. Those returns also correspond with the alpha, which is the added value through active management. You can see that the managers produced, on average, over this 3-year period, Causeway produced 5.87% added value through active management on an annualized basis. And you see that Harbor, 2.59, Oakmark, 7.34, and Tocqueville, 2.43. So active management producing significant value. Following page 8, that says top 5 holdings are the individual largest holdings of all these portfolios as of year-end. Most of these names we know: Akzo Nobel, Siemens, Toyota for Causeway, Harbor, BBVA is a Spanish bank, AXA, which is a very large insurance and financial services, Roche, Lloyds Banking, and Allianz. Allianz is common between Harbor and Oakmark, but also Oakmark investing in very large European brand names and also banks as well. Oakmark is a traditionally contrarian fund. There are short periods of time that they don't do well where they're effectively investing ahead of the market, but large financials allocation there. And then Tocqueville has some of the more unusual names, given that they're smaller companies: Hitachi, Siemens, Novartis. Then you have the Compagnie de Saint-Gobain at 2.6% of the portfolio. Tocqueville traditionally has had a reasonable allocation to Europe and to France, somewhat of the history of their organization, but it hasn't hurt results. In fact, we think it gives them the unusual level of understanding of those companies. Sort of a similar look on page 9, but not top 5 companies, top 5 country allocations. And you see a lot of difference between these. Some of the names are similar, but the rank order is significantly different. Causeway, the largest holding in Japan at 12.9%, which is less than the benchmark. France at 12.7%. Germany, Switzerland, and the Netherlands down at 7.7%. You'll see Harbor, France, UK, Switzerland, Germany, Japan. And the one thing that you'll notice significantly different is where Japan comes out in all of these names. Tocqueville has 25% of their portfolio in Japan, which was very helpful last year because that market turned on a dime. You'll see 25% for them, less than 12% for Oakmark, less than 9% for Harbor, and then back up to 13% for Japan. So international equity investing, there are many different layers that we don't have to deal with domestic equity. You have stock selection, you have industry allocation, you have country selection, and then you have currency management. But in the modern era of investment managers, you do not see currency hedging very often. They leave that up to you as the investor. Occasionally, you'll see managers hedge Japan or the euro, but that's about it because they're such large allocations. The bottom 2 items are developed market exposure and emerging market exposure, and this is as a percentage of the portfolio's allocation. Causeway in this portfolio will not invest in emerging markets. Harbor can invest up to 20%, but they're very low right now. Oakmark, extremely low. And that should be, it should be. Thank you. There's a 91%. What's interesting about the classification between developed markets and emerging markets is that it's made by this organization, Morgan Stanley Capital International, MSCI indexes. And since the emerging markets index was first made almost more than 20 years ago, there's never been a country graduate from emerging to developed. So if you think about a country like South Korea, which is an incredibly stable, property rights-oriented, high-tech country, they're still in the emerging markets index. Last year did see something interesting. We saw our first relegation or demotion from the developed index to the emerging. Oddly enough, the oldest country in the index, Greece, was relegated back down to emerging markets after everything that they did. So we see a nice dispersion or nice choice between these portfolios. You'll see the expense ratios on the following page, on page 10, and the fund asset, net assets. You'll see there are quite a bit of range here. Causeway at $3.2 billion is a younger organization than Harbor or Oakmark. Harbor is incredibly large. Tocqueville, again, this is a newer portfolio for them, and this mutual fund has $0.3 billion in assets under management. The rest of them are in billions, and that's why their fee is a little bit higher. International equity investing is more expensive than domestic equity because you're putting people on planes and sending them overseas to meet with companies, and that's why you see the higher expense ratios. I'm not sure how deeply you want me to go into this, but I'm open to take any questions. Find the best way to move forward on this. We think that any of these options on their own are a more than adequate replacement for Thornburg, which unfortunately we have lost our faith in that organization and that this particular portfolio, given the recent management changes there, and want to know what's the best way to move forward with this.
So do you have a recommendation on this with which one of these companies that you feel like fits our portfolio the best?
Sure. And I think that Tocqueville is a little bit of a stretch. I mean, their companies are much smaller. I think they can have extended periods of underperformance. I think Harbor, their portfolio is a little bit on the large side. I don't have the great feeling about that. Oakmark has really been on such a tear that they've done extraordinarily well, but we've seen them consistently perform that well. In my mind, the two best candidates are Causeway and Oakmark. Causeway is a smaller organization. They're very disciplined. But again, I don't want to select it based solely on recent performance. I want to think that going forward over the long term, I think that we will have periods with any of these that there will be some underperformance. I think I would favor Causeway slightly over Oakmark. I hope you hear from my voice, I'm not very strong in that conviction because both of them are extraordinarily talented groups. I think Causeway, for one reason, is that there are several people on the portfolio management team, whereas Oakmark is one fellow, David Harrow, who I know that sometimes committees can slow things down, but if he decides to leave, then that portfolio ceases to have any attraction for us.
As I mentioned, you're not able to take any action today. We just wanted to let Doug give you an idea of who he might be recommending. We'll go ahead and include this on the next meeting's agenda, at which point you'll be able to take action on it at that point in time. And we'll work with Doug on, in case we need him to come back and, kind of touch and give you some reminders on each one of the recommendations.
Okay.
Bob, I appreciate that you'll put this on the next agenda. And given that we have another manager that's on notice also, maybe we could include something on our subsequent agendas so that in the event that we determine that we want to make a change, we could do that.
Sure. We will
Sort of like
work
an
with Doug on
executive
that.
session for labor negotiations, where there might or might not be something to talk about. For instance, is that okay if we do that? I think especially since we'll have another manager that's still on notice, it would be helpful to have the opportunity to be a little more agile.
Okay. We'll certainly work with Doug on that.
Thank you.
All right.
All right, thanks. Are there any other items from trustees or from anyone on the staff? Hearing none, then we are adjourned.